Hey there, and welcome. If you're looking into ways to lock in your retirement income, you've almost certainly come across annuities. They promise a lot of stability, right? But with any big financial move, there's always that one critical question.
So who's actually making sure these products are solid? Who are the watchdogs looking out for your interests? In this explainer, we're going to pull back the curtain on the different layers of regulation, all designed to protect you, from your own state all the way up to the federal government.
All right, so where does the oversight really begin? Well, for the huge majority of annuities out there, your first and honestly, your most important line of defense is right there in your home state.
That's right. The main players here are your state insurance commissioners. You can think of them as the gatekeepers. Before any insurance company can even think about selling an annuity in your state, they have to get the green light. And their products, their practices, everything has to meet a really strict set of standards. But what exactly are they looking for?
Well, the state's process is pretty darn thorough. First up, they license the companies. Simple rule, no license, no business. Second, they are constantly monitoring the financial health of these insurers, making sure they actually have the money, the capital, to back up all the promises they make. And third, they even check out the folks in charge to make sure the company's leadership is on the level and knows what they're doing. It's this three-part approach, all designed to protect you from the get-go.
Now you're probably thinking, okay, but does this change from one state to another? And the answer is kinda yes, kinda no. To keep things consistent, there's a group called the National Association of Insurance Commissioners, or the NAIC. They create what are called model laws, basically a template, that most states then adopt. This helps make sure that no matter where you live, the core protections you have are based on a common, solid playbook.
But state-level oversight is just the start of the story. See, not all annuities are created equal. Some are a lot more complex, kind of blending insurance guarantees with investment-style features. And when that happens, a whole new team of regulators steps onto the field. So, let's break it down. On one side, you have your traditional fixed annuities. They're pretty straightforward, so their regulation just stays with the state insurance department. But on the other side, you've got variable annuities, and these things called RILAs, that's Registered Index-Linked Annuities. Because their potential returns are tied to the market, they're actually considered securities, and that means they get a double layer of oversight. The state is still involved, for sure, but now the big federal agencies jump into the mix too. And who exactly is on this federal team? Oh, just the heavy hitters. You've got the SEC, the Securities and Exchange Commission, regulating the products themselves to make sure everything is disclosed properly. Then there's FINRA, which focuses on the financial professionals who sell them, setting the standards for how they operate. And of course, you can't forget the IRS, which sets the all-important rules around the tax advantages, like tax deferment that make annuities so attractive for retirement planning.
Okay, so we've met all the regulators. But what does all this bureaucracy actually mean for you? When you're trying to make a smart decision. How does this stuff translate into real-world protection?
This right here is probably the single most important piece of consumer protection to come along in years, the best interest standard. This is a huge deal. For a long time, the rule was just suitability, which basically meant a product was generally appropriate. But now, a professional has to actually show that their recommendation is truly in your best interest after looking at your whole financial picture. It's a way higher bar, and it's all about putting your needs first.
And here's another really powerful tool you have. Every state requires a free look period. Depending on where you live, this gives you anywhere from 10 to 30 days to pore over every single word of your contract. If you don't like something or you just change your mind, you can cancel and get 100% of your money back, no hassle, no questions asked. It really is the ultimate consumer safety valve.
And what if you're thinking about switching from one annuity to another? Well, regulators are especially watchful about that. To make sure you're not getting a bad deal, there are extra safeguards built in. You'll have to sign forms that clearly state any surrender charges from your old contract, and the professional has to write down exactly why the new product is a better move for you. Now, let's talk about the absolute worst-case scenario. What if an insurance company actually fails? That's where state guarantee associations come in. It's kind of like the FDIC for banks, but for insurance companies. They provide a layer of protection, but, and this is so important to remember, it is limited. How much is covered can vary a lot from state to state. So you really have to see this as a last resort safety net, not a replacement for choosing a financially strong company to begin with.
And that brings us to what might be the most crucial takeaway from this whole explainer. This quote really says it all. Regulators make sure companies follow the rules about having enough money, but they don't give them a grade, like an A+ or a B-. That part, well, that's up to you.
Which brings us to our final section. Because even though this regulatory framework is strong, it's really designed to be a partnership. The whole system just works better when you are an active, informed buyer.
This chart here sums up that partnership perfectly. On one side, you have the regulator's job. They enforce the financial rules, they police misleading ads, and they set the standards for salespeople. But on the other side is your role, to really judge a company's ability to pay its claims down the road, to research its reputation beyond just the fancy marketing, and most importantly, to ask the tough questions to make sure a product is the right fit for your life.
So how do you do your part? Well, your best tool, hands down, is looking at independent financial strength ratings. You need to see what firms like AM Best, S&P, Moody's, and Fitch have to say. They do the deep financial dives that regulators don't publish, giving you an objective look at how stable an insurer is likely to be for the long haul.
So we'll leave you with this final thought. The regulatory system provides a really powerful safety net built with all these layers of protection. But at the end of the day, that net is there to support an informed decision, not to make it for you. So the ultimate question is, are you ready to be your own best advocate? Thanks for tuning in.